The stock symbol is SGA. This is a focused radio broadcast company with significant digital growth opportunities ahead of it. And before we get started, I want to mention that I cover Saga with an outperform rating and an $18 price target. Of my radio coverage, Saga has the most pristine balance sheet, and the stock trades among the lowest valuations relative to its peers, which is a head scratcher. So I do believe that this is one of the most compelling values in my universe. With us today are Chris Forgy, who's the CEO, and Sam Bush, the CFO. This will be a fireside chat, but if you have questions, please don't hesitate to send those to me in your chat box. So let's get started. First, I would like to turn it over to Chris for opening remarks. Go ahead, Chris.
Thank you, Michael. And for those of you who have followed the broadcast sector for a period of time, probably have heard a lot about radio and TV's digital strategy. Saga's digital strategy, I'm going to jump right into it because that seems to be one of the bigger questions that we get from investors is talk about your digital strategy and how it differs from your brethren and like. So I wanted to touch on that. It's really less of a strategy and more of a transformational change. And it's a change in company culture. For example, our business units are now called media groups. Our sellers are referred to as media advisors. And our program directors and on-air are termed and now called directors of content and content creators, respectively. So the question becomes, why is this forward-facing transformation going on now? Well, as Michael has said before, we were about 10 to 12, maybe 15 years late into this digital party. So we were way behind. The benefit to that was that we had a luxury of observing and learning from the iterations and reiterations and the failures of our broadcast brethren. As I've said before on earnings calls, the second mouse really gets the cheese in this case. So Saga's digital strategy is really based on the premise of this, that local advertising is overdue for disruption. And it just so happens that Saga Communication, in its 27 markets that it operates in, are in the size of markets. 21 of the 27 markets we operate in are below the size of market 100. So we really have an opportunity to impact those markets. We have a strong impact, as I mentioned, and an influence on the local communities in which we operate. And that includes the advertising community. And these local advertising markets are ripe for disruption, and here's why. Businesses now are pouring more money into digital every year. We see it in the reports from Burrell and from BIA. But the rapid growth of the digital budgets has outpaced its ability of advertisers to completely understand and use them efficiently and effectively. There are too many digital providers. There's too many conflicting solutions. Businesses don't know who to trust. And in this case, simplicity and clarity with a simple click, visit, and call and search approach for the consumer journey is what really wins. Another reason is advertisers are fed up with ineffective campaigns and empty promises. They don't like what they are buying, and they don't like who they're buying it from. And finally, there's a shift in consumer behavior. Advertising strategies haven't caught up with the journey the people take when they buy. In other words, search and display is broken. And there's a gap where tech meets human behavior. So we believe that focusing on the influence of ads in the real consumer journey, when a consumer interacts with a product or service, this approach will allow Saga not only to win the market, but also to redefine it. And that's what we're in the process of doing. We also believe today, and frankly, I consider myself a purist. I've often described myself as somebody who is the Bob Costas of radio. And but in today's environment, you've seen it. Radio alone, radio by itself is not going to be enough. Radio is powerful. It's the most powerful medium ever in existence. But without search and display to capture that action, potential customers are lost. Every radio ad only and always leads to a search. And if our clients aren't there when they search with the message that inspired them to go looking for in the first place, we're just creating business for their competitors. And we call this process the blend or blended advertising. Local direct advertisers are under assault. Without a clear understanding of what radio does for them, they have the potential to significantly reduce their overall ad spend, and I'll share that with you in a minute. These markets that pitch radio only could lose large portions of their business over the next couple of years, and that's no big secret. We see it all the time. We're seeing it now. We believe the adoption of the blend will preserve and grow radio and realize digital numbers that will allow Saga to double its annual gross revenue, most of it being digital, by disrupting just 5% of the available digital dollars in just search and display, not social or any of the others, just search and display in just 16 of our 27 markets. So to further illustrate, I'd like to share some, if you don't mind, some statistics that I think you'll find interesting. In 2024, excluding political, there was $421 billion spent on advertising in the US. 73% or $309 billion was spent in digital. Now, 2025 estimates of ad expenditures in the US, they're anticipating that topping $456 billion, and 80% or $365 billion going to digital. So in comparison, radio gets just 5% or $21 billion of the total ad spend. And according to BIA Kelsey, radio gets a pedestrian 0.6% of the $2 billion of the total ad spend from digital, or $2 billion. That's it. In 2024, radio wrote $2 billion in all of digital, which is less than 0.6% of the total digital ad pie. So I mentioned some research that we had, and this is a sample and a small sample, but we're starting to see some really significant results and impacts of the digital strategy on our core business and in our digital space. Local advertisers who are not pitched the blend, we lose 29% of the existing radio business that we had prior to. Local direct advertisers that bought the blended product, and we define the blended product as search and display, the radio spend increased by 9%, and the radio and blended spend increased by 27%. Local direct advertisers that did not buy a blended product, search and display, their radio spend still decreased by 13%. So that they did not buy a blend and were not pitched it, their radio would drop by 13%. And finally, local direct advertisers who were pitched a blended product and still didn't buy the blend, we still saw a 1 to 2% increase in our radio spend. And again, that's a small sample, an early sample, but it's showing some things that are really significant in terms of the strategy is galvanizing, it's taking hold, and it is working. And it preserves and grows our core competency, which is radio. So in conclusion to my, thank you for letting me make these opening remarks, because I think it will help to kind of set the fireside chat in motion and maybe spur on some additional questions that both Michael would have and you would have. But in conclusion, Saga's blended strategy gets our advertisers wanted, found, and chosen more often than their competition by getting them more clicks on their website, more visits to their store, more calls to their operators, and more searches on Google, Meta, TikTok, or whatever the search engine is. So with that, Michael, I'll turn it back to you. And I know we'll probably have lots of questions, but I did want to set the stage for our fireside chat. Thank you very much.
No, I appreciate that, Chris, very much. And thanks for that color. Really appreciate it. You know, it's interesting that Saga, you know, to put a little context behind this, Saga has consistently outperformed that of its radio peers up until when the radio industry started to kind of pivot and start developing its digital businesses. I mean, consistently every year, Saga delivered better revenue growth than anyone else in the industry. And so it seems to me like maybe your markets that you're in might provide some, insight into the opportunities that you have. So maybe you can talk a little bit about your markets and why your markets are so attractive, and of course in the context of the digital opportunity, you might want to talk about how you might regain that throne, so to speak, of delivering better revenue growth than others.
Sure, I'd be glad to do that. As I mentioned earlier, we operate in 27 markets across the country, and 21 of our 27 markets are smaller than Market 100. We focus on markets, small to medium-sized markets that have state capitals, state universities, have strong agricultural industry, and more recently, large retirement communities with high net worth, like Ocala, Florida, where they have the villages. Um, the market Saga operates in, we're known, liked, trusted. We pour ourselves into our teams and get involved in government. We've had people in our offices and our markets that have been asked to run for mayor. Many of them serve on city council and are active in the local community, very active. As I mentioned, we pour ourselves into the community by design. Um, and we raise money for important causes where the money we raise stays in the community, and is impacted by both the people that live there and work and enjoy life there. We're part of the fabric of the community, and we get belly to belly with the advertisers, with the influencers and decision makers, um, to move business forward. And finally, Saga does on an average about $1 million to $1.5 million more a month in local direct business than we do in local agency business. The reason I bring that up is the driver of the blended strategy is local direct business. So the fact that we are active in the market, we're already trusted, we're a trusted source, we are a liked source, they like us, trust us, and respect us. We're active, they know us, we can get belly to belly to with people that make the decision in the advertising communities, and they are direct business owners. And because of those things, we're able to impact the markets at a higher rate and a more effective rate than perhaps our brethren.
I think that's a great explanation. And I was wondering, I don't think we need to get into the details about your digital start, but you did have a late start. And then, but the way I look at it, it offers an outsized revenue and cash flow growth opportunity for the company. Can you discuss where the company is on its journey to develop these additional revenue streams and the challenges and maybe the wins where as you kind of gone on to this journey?
Yeah, we've seen significant wins. At one point, we had written in a period of about 7 days, $2 million in blended advertising. We believe that, and we can talk about this a little more detail. When we developed the strategy, and I mentioned all the disruptors that we saw in my opening statement about what we saw and why we saw it. More specifically, we found that if we can just impact or disrupt 5% of the amount of money that's spent in our markets, only our markets, in search and display, we believe we can double our annual gross revenue in a relatively short period of time. And that kind of thing has already started. I mean, there recently, our digital strategy is growing month over month, quarter over quarter, year over year. July is better than June. August is better than July. September is better than August. And our digital percentage of total net revenue has also increased quarter over quarter, Michael. It's gone from 13 to almost 16%. And we're on a move to get it to 20, 25 and above. We, from a 3 to 5 year goal perspective, we would see our business model looking like this: 1/3 radio, 1/3 search, 1/3 display. And that's how we see the model going forward. So there are a number of individual successes that we continue to have. But the big piece is when we're seeing our average radio order on a month, for example, given an average market of $2,500 to $3,000, the orders that we have realized are $30,000, $40,000, and $50,000 a month. So you can see the kind of increase and the fact that we've taken almost all of the resources, the third-party resources that we have used, and brought them in-house. So our R&D has increased. We're adding people, offsetting costs, and increasing margins because of the way we're producing and fulfilling the strategy.
And Chris, I don't want to I want to make sure I heard this right. You anticipate that your digital revenue, total digital, could be as much as 65, 67% of total company down the road. Is that what?
Yes, yes,
Okay. All right.
yes.
Okay.
And
I
and
know.
and you have to have radio to make it work, because that's what preserves the medium that I personally, Sam, have grown up in and love, and that's what it does. It grows and preserves the medium that we grew up in, and we have to have it because it's the driver to get people wanted. Because the idea is wanted, found, and chosen. Search gets them found, display gets them chosen, radio gets them wanted.
Yeah. And that's certainly in line with what another radio company we just had on here earlier has kind of indicated. Um, the other question is, I guess, if you kind of look at, Saga relative to the size of others that, you know, your development of your digital businesses and so forth. We get questions from investors. Does Saga have the skill set to develop, a well-rounded digital platform? And as you talked about, Chris, you're saying, hey, search alone is a big opportunity for us. How do you feel in terms of Saga, kind of developing this on its own versus seeking third party or white label services to round out your service offerings?
Well, Michael, I think one of the things I've observed, and I mentioned this in my opening statement, was that because of our brethren we've had the opportunity to watch this go on for some time, and they started, reiterated, and then failed, and then they would start again and fail and start again. So one of the observations that we made, right or wrong, was that we believe that part of what was going on is that the overuse of third-party providers, because it's not the balance sheets that kills you, it's the how much, or it's the debt that'll kill you, and the amount of debt you carry. So some companies really, in their failures, kept trying and trying again and doubling down on things that hadn't worked. So we had the opportunity to watch these things unfold, and we believe that we've now acquired, and we have the very best training, we believe, anywhere, to talent and train our media advisors. The other piece is, we also believe this is a fundamental difference of some of our competitors, is that we don't allow third-party providers to be the experts. Our media advisors and our leaders in our building are the ones who fulfill and do this. They don't have digital experts in the building. They are the digital experts. We've charged them over the past year and a half to 2 years to be able to know the digital space as well as they know the radio space, or better, and then how the two work. So we've spent 2+ years in just training and research and development and acquiring talent to train our MAs and market leaders, our media advisors and market leaders, and to fulfill the needs of our customers, and all doing it in-house. And we still only maintain just one third-party provider. And recently, they said to us, I got to read this because they sent it to us. One of our third-party digital partners referred to Saga as one of their leading and fastest growing digital channel partners. And this isn't a small third-party provider. This is a well-known third-party provider that we use for our display. So they're seeing what we're doing, and nobody's really ever done it like this. So we're a bit of a pioneer. And is it the best way to do it? I don't know. I haven't seen a better one. It's our path.
Yeah. And I know that we talked a lot about digital, but you have other growth initiatives to drive revenue as well. We talked about e-commerce. We talked about, you talked about e-commerce in the past. You talked about national, which is interesting because national, you wouldn't think in some of your markets would be a big component, but you might address some of those other growth components that you think could drive revenue as well.
Well, one of the things that I don't believe in, I think larger markets are seeing this a little quicker than we are. I don't think you can any longer rely on national to bring you home. It's not going to do that. And when you look at network advertising, that's not going to do it either. And when you see a downturn in both network and remnant advertising, where you'll hear Progressive Insurance and Home Depot and the like, and they'll be in these, you'll hear a lot of their commercials on the air, and most of that is either network or remnant, where they're paying low cost per thousands for those. And when you see that business, which is the kind of the bottom of the drain, start to drop, then you know things are in trouble. So we've over the past 2 years, while we're building our digital strategy, our blended strategy, we've also employed things like you mentioned, e-commerce, which is a phenomenal growth area for us. We went from $400,000 in 1 year to about almost 3 million about a year and a half later, from really from nothing, and are still growing. Our streaming revenue is continuing to grow, and we have some stations now are realizing 30% of their terrestrial delivery is on the stream also. That's another challenge for our industry down the road, is what happens when the stream outperforms the terrestrial delivery. So that's another piece. So, and then we have in 17 markets, we have an online news service, which is basically an online newspaper. And we do those in markets that are of such size that once again, we can be a resource and a delivery system for advertisers and for the community to get news. It started with Clarksville Now, in Clarksville, Tennessee, and now we have them in 17 of our Saga markets.
And I know we're getting a lot of questions about the balance sheet, and I promised to get that and bring Sam into the discussion. But before I
Yeah.
do, I have one more question about radio. We had an executive that indicated that he didn't believe that radio will grow again. And I was just wondering what your thoughts on the prospect for radio spot advertising to show growth outside of the political advertising cycles.
Well, I think when people say that radio is not going to grow anymore, I think they're probably looking in the verticals that I mentioned, particularly the larger companies, because they're probably right. They're not going to see the growth in national. They're not going to see the growth in remnant. They're not going to see the growth in network. Those days are over. Regional, that's probably going to be a difficult time too. Fortunately for us, we are in markets, as I said, when we can impact and have an influence in those marketplaces. And we believe that the local direct advertiser, with all the complications and all of the confusion in this advertising space, not just the digital space, but the advertising space, it's getting much more complicated and confusing. The more simplistic we can make it and easy to understand and easy to attribute, the better we are. And that's where we're building our strategy from. So yes, I believe that local radio can come and continue to grow. We're counting on it.
Gotcha. And Sam, I want to bring you into this discussion. You have a pristine balance sheet. In the past, you've made selective acquisitions. You've been very diligent about which ones that fit your profile, and you haven't stretched your finances. And I was wondering if you could talk a little bit about your acquisition strategy, and especially, in light of some of your radio operators that carry massive amounts of debt. Mm-hmm. So this obviously distinguishes you apart from the rest.
Yeah, Michael, you're not going to see. I mean, Saga's always been a conservative operator from an acquisition strategy, and you're going to continue to see that. I do think there's going to be some opportunities as we look at what the FCC does if they relax the ownership limits and so forth. I tell people I think it's going to be like pro sports. Team A is going to trade somebody to Team B. Team B is going to trade somebody to Team C, and Team C is going to trade somebody back to Team A. So I think there's going to be multi-party deals that go on, and we'll be looking at our portfolio from that standpoint and say, do we want to continue to be in this market, or is it better by somebody else? We've already had a couple of people approach us about acquiring bigger positions in the markets we're already in. And so forth. Likewise, we're going to pick and choose markets like Lafayette, Indiana, that we bought, the most recent market we bought. Previously, things like Ocala, Florida, Charleston, which have done very well for us. And the net effect is, well, we're never going to risk our balance sheet from that standpoint, but we do see some opportunities in continuing to bulk up in markets and finding other markets as well. But at the same time, and I know we're running out of time, I'm going to jump a little bit and talk about dividend and buyback policy, because that's all part of the capital strategy. We have definitely had a significant dividend policy since 2012. I know we have some shareholders who would like us to not do dividends as much as we've done, do more stock buybacks. We have said when we and our asset sales and potential, what we're doing. We have indicated to the market that we currently do, and I thought it would be closed by the end of September, and we could be talking about very specifics on a tower sale that takes into consideration 22 of our tower sites. It's basically a low 10-figure number, high 10-figure number, or low high 7-figure number, low 8-figure number that we're looking at in the 8 to 10 to $11 million range. So it's significant numbers, and we've committed to put a significant portion of that into a stock buyback as the time, whether it's a private market buyback from sellers, shareholders of our stock that have a desire to sell. We do intend to continue, and it's obviously up to the board of directors, but we do intend to continue our quarterly dividend. And I don't expect, even though it's paying a really strong yield right now, we'd like to see our price grow into that yield as opposed to us changing the yield based on our price. So we are very, very focused on giving our shareholders what we think they need, and return of capital to the shareholders as we continue to do what we're doing and as we move through the transition and blend it.
Those were a number of my other questions, but I do want to highlight the fact that you had mentioned in-market radio station acquisitions. For those that may not understand what that means, it's significantly accretive for you to make those acquisitions and to take out the added cost of adding another radio station in the market that you're already in. So
yeah, and you will definitely see that, Michael. That's one of the things that we will focus on, whatever the FCC does.
That's right. So one of the things, and this will be my last question, we have just a minute here, and I think we have addressed most of the questions that I see coming in. The shares trade at a substantial discount relative to your radio peers, and which are trading at much higher multiples. And when you look at their high multiples, they're largely trading on substantial debt leverage when you look at the enterprise value. What do you think? Hopefully maybe the stock repurchase kind of get the stock, narrowing that gap a little bit. But what do you think would be the catalyst to narrow the gap and possibly, kind of attract investors to really take a look at Saga?
I think we need to show the performance that we're beginning to see under the transition to blended sales, so we can prove to the market that the philosophy is working, as we know it will, and be in a position where we're seeing stabilization, if not growth, in traditional radio, various aspects, growth in areas like e-commerce, continued growth in streaming, continued growth in online news, and some of the events we do, and likewise show the strong ability of radio to prove out the digital strategy is working and drive business there. And we get that going in the way, as you mentioned early on, that we historically have led the industry in financial performance. And because of the transition and the money we're spending and the revenue that declined to some extent because of all sorts of reasons, economic and otherwise, I think it takes putting us back on that footing, as well as to show the industry that we are going to do what we say we're going to do on the capital structure.
Well, your balance sheet is a big differentiator relative to your peers. I think you have a history of a very compelling return of capital of shareholders. The stock valuation's very compelling. I really do encourage that the listeners on the call today to take a look at my research on channelcheck.com and take a look at Saga SGA. I think it's a very compelling story, a very compelling total return story. And with that, I'd like to thank both Chris and Sam for joining us this afternoon, and thank you for listening. Thank you, everybody.